Most people who come into trading think success is about knowledge, strategy, or indicators. They believe that if they can just find the right setup, the right system, or the right signal, the money will follow. But the truth is, it doesn't work that way. Trading isn't a game of information. It's a game of transformation. It's not about what you know. It's about how you think, how you feel, and how you respond under pressure. The market doesn't care about your dreams, your background, or your education. It only mirrors your ability to stay disciplined when uncertainty feels unbearable. You see, the markets are a psychological battlefield where the real fight isn't with other traders, it's with yourself. Every decision you make exposes what you truly believe about risk, control, and self-worth. That's why two traders can look at the same chart, the same setup, and take completely different actions. One sees opportunity, the other sees danger. One acts with confidence, the other hesitates and misses out. It's not the market that determines their fate, it's their mindset. If you've ever felt that deep frustration of taking a perfect trade and still losing money, or missing out on a winning move because fear froze you, you're not alone. Every successful trader has been there. But what separates the few who make it from the many who don't is how they interpret those moments. The average trader blames the market, the strategy, or bad luck. The successful trader looks inward. They ask, unto what belief, what emotion, what fear caused that decision? And then they work on it relentlessly. Trading will test your patience, your ego, and your resilience more than anything else in your life. It will expose every weakness you try to hide. But that's exactly why it's the greatest teacher of self-mastery. The people who make it in trading don't just master their strategy, they master themselves. They understand that consistency in results begins with consistency in thought. They no longer need the market to make them feel right. They just follow their process trade after trade without emotional interference. If you ever wondered whether you have what it takes to make it in trading, stop looking at your account balance or your win rate. Those are just reflections of something deeper. Look instead at how you handle uncertainty, how you manage loss, how you recover from mistakes. These are the true signals that tell you where you stand. There are 5 clear signs that reveal if you're truly on the path to mastery in this game. 5 inner qualities that, when developed, make you unstoppable, not because you control the market, but because you control yourself. Once you recognize these signs within you, trading stops being a struggle. It becomes a flow, an expression of calm confidence in the face of chaos. And that's when everything changes. Emotional control outweighs technical skill, because in trading, your mind determines every outcome long before the market does. You can learn every pattern, master every indicator, and backtest a strategy 1,000 times, but none of that matters if you can't execute it calmly under pressure. The markets are designed to trigger your emotions. Fear when things move against you, greed when they move in your favor, and impatience when nothing seems to happen. These emotions distort perception. They make you see opportunities where there are none, and danger where there is only temporary noise. That's why two traders can trade the same chart with the same tools and still end up with completely different results. The difference lies in how each one manages the psychological storm within. When you place a trade, you are not just risking money, you are putting your beliefs about success, control, and self-worth on the line. Most traders think they are reacting to market movements, but in truth, they are reacting to the feelings those movements create inside them. A small loss can feel like personal failure. A missed move can trigger anger or regret. A string of wins can make you overconfident, convincing you that you finally figured it out. This emotional roller coaster is what destroys most traders. Not lack of skill, but lack of control over their own minds. Every decision in trading happens in an emotional context. You may believe you are being rational, but your brain is wired to avoid pain and seek pleasure. When a trade moves against you, the pain of potential loss activates fear, the same primal response humans have had for survival for thousands of years. That fear can make you close a position too early, change your stop loss, or abandon your plan entirely. Conversely, when a trade goes in your favor, pleasure floods the brain and you start believing you have control over something you don't. You take bigger risks, you ignore rules, you start trading your emotions instead of your edge. And then the market reminds you who's in charge. Emotional control begins with awareness. You can't manage what you don't notice. The first step is to observe how you feel before, during, and after every trade. Notice the physical sensations. Tension in your shoulders, tightness in your stomach, the racing thoughts when price moves quickly. These signals tell you that emotion is influencing your decision-making. The goal is not to eliminate emotion, but to recognize when it's taking control. Once you can see it happening, you can step back and return to logic. Many traders believe emotional control means suppressing feelings, but that's a misconception. Suppression only pushes emotion deeper, where it builds pressure until it bursts at the worst possible time. True control comes from acceptance. You acknowledge the fear, the excitement, the frustration without letting it dictate your behavior. You become the observer of your emotions, not their prisoner. When you reach that state, trading becomes less about reacting and more about executing. You stop chasing the market because you no longer need constant confirmation that you're right. There's a powerful moment that happens in every trader's evolution. The realization that your biggest losses didn't come from bad trades, but from emotional ones. The trades you forced because you were bored. The ones you doubled down on because you refused to accept a loss. The setups you ignored because you were afraid of losing again. Each of those mistakes was emotional, not technical. Once you see that, you begin to respect emotional control as the real skill to master. Strategies are easy to learn. Self-mastery is not. A trader with emotional control understands that every trade is just one event in a long series of probabilities. There's no need to attach personal meaning to any single outcome. A loss doesn't define you. A win doesn't validate you. What matters is whether you followed your process with discipline. When you detach from the emotional highs and lows, you can see the market clearly. You start responding instead of reacting. You act from a place of calm confidence, not desperation or fear. To develop that state of control, you must create structure. Rules are not restrictions. They are anchors that keep you grounded when emotions try to take over. Your trading plan should define exactly when to enter, where to exit, how much to risk. Once those decisions are made, your job is to follow them without hesitation. The market may tempt you to deviate, to chase, to add size impulsively. Emotional control is what keeps you from listening to that temptation. It's the internal voice that says, follow the plan, even when every nerve in your body screams otherwise. Journaling plays a crucial role in building emotional awareness. After every session, write down what you felt and why you made certain decisions. Over time, patterns will emerge. You'll notice that your worst trades often follow frustration, boredom, or a desire to make back losses quickly. You'll also see that your best trades come when you're calm, focused, and detached from outcomes. That awareness is your map to emotional control. Once you recognize your triggers, you can anticipate them and neutralize them before they sabotage you again. It's also important to understand that emotional control doesn't mean being emotionless. You can't remove fear or excitement from trading. They are natural responses to uncertainty. The goal is to reduce the intensity of those emotions so they no longer cloud your judgment. You achieve this through experience, repetition, and a deep belief in your edge. Every time you follow your rules instead of your impulses, you reinforce the habit of control. Over time, that becomes your default state. Discipline is the external expression of emotional control. When you have control, you no longer need to chase the market or prove yourself right. You stop comparing your progress to others because you understand that your only opponent is your own inconsistency. You focus on process, not profits. You start thinking in terms of probabilities, not certainties. You accept that losing trades are not setbacks, but necessary parts of the game. Each one tests your ability to remain composed, to keep executing with clarity, without emotional control. Even the best trading system will fail. You'll exit too early, hold too long, or abandon your plan at the worst moment. You'll oscillate between fear and euphoria, always reacting, never mastering. But with control, even a simple strategy can produce consistent results. You no longer need to predict the market, you only need to manage yourself. That's the shift that separates consistent traders from emotional gamblers. The market will always test your emotional limits. It will reward bad habits just enough to keep you overconfident and punish hesitation just enough to make you fearful. The cycle never ends. But once you understand that every test is an invitation to strengthen control, you begin to trade from a different level of consciousness. You no longer fear volatility. You embrace it as the natural rhythm of opportunity. You no longer panic during losses. You treat them as data. Emotional control transforms trading from chaos into rhythm, from stress into flow, from random outcomes into deliberate progress. Consistency in mindset leads to consistency in results because trading outcomes are a direct reflection of your internal state. Most traders think consistency comes from perfect strategy, accurate entries, or a secret pattern. But the truth is far simpler and far more difficult to master. It comes from the ability to think, feel, and act the same way regardless of short-term outcomes. The market rewards those who can remain mentally stable in unstable environments. Every trade you take is a mirror showing whether you are disciplined or emotional, focused or reactive, patient or impulsive. If your thoughts shift with every win or loss, your results will too. A consistent trader doesn't wake up and let emotions dictate behavior. They know that mental stability is their most valuable capital. When you are inconsistent in mindset, some days confident, other days fearful, your trading decisions follow that same pattern. You hesitate when you should act, overtrade when you should wait, and exit early when you should hold. These fluctuations don't come from the market. They come from within. The markets are just a constant stream of opportunity and risk. It's your mental interpretation that turns them into chaos or clarity. Most people start trading chasing profits, thinking that consistent money comes from consistent setups. They spend months adjusting indicators, experimenting with entries and rewriting their plans, but nothing changes. The reason is they're fixing the wrong problem. Consistency in results can only come after consistency in thinking. If your mindset isn't stable, no amount of strategy will save you. You can't expect reliable results from an unreliable mind. When your beliefs and emotions shift with every trade, your system becomes useless because you'll never execute it the same way twice. Consistency starts with defining what you believe about trading. Do you truly accept that losses are inevitable? Do you genuinely understand that probabilities govern every outcome? Many traders say they do, but their behavior reveals otherwise. The moment they lose 2 trades in a row, they change systems or reduce position size out of fear. The moment they win 3 in a row, they double their size out of greed. These shifts destroy consistency because they break the link between logic and action. A consistent mindset accepts randomness and still acts with discipline. It understands that success is measured over a series of trades, not one. Developing consistency in mindset requires emotional neutrality. It means no longer being attached to outcomes. Wins and losses lose their emotional charge. You stop feeling euphoric when you win and devastated when you lose. Instead, you analyze results objectively, asking only one question: did I follow my process? That process-centered thinking is the foundation of consistency. When you no longer measure your worth by short-term results, you free yourself from the emotional volatility that ruins decision-making. Each trade becomes just another data point in an endless sequence, not a verdict on your ability. The consistent trader understands that markets are unpredictable, but behavior is not. You can't control what the market will do, but you can control how you respond. Every day you bring the same level of focus, discipline, and patience to the chart. Regardless of what happened yesterday, it's this repetition of stable behavior that compounds into consistent results. The mind becomes conditioned to operate in uncertainty without emotional interference. You stop chasing setups or forcing trades because you no longer crave validation from the market. One of the biggest barriers to consistency is the need for immediate gratification. Trading attracts people who want fast results, but real consistency is built slowly through thousands of disciplined repetitions. You can't expect the market to reward you until you've proven that your mind can handle both success and failure without losing balance. Consistency means showing up the same way after a losing week as you would after a winning one. It means treating every trade with equal respect, not because of potential profit, but because it's another opportunity to prove mental stability. Your self-talk determines much of your consistency. The way you think about a loss, the words you use after a mistake, the stories you tell yourself after missing a move. These internal dialogues shape your future performance. If you constantly criticize yourself, your confidence erodes. If you justify emotional trades, your discipline fades. A consistent mindset speaks with clarity and neutrality. It acknowledges mistakes without judgment, focuses on improvement, and refuses to assign emotional weight to random outcomes. That steady inner dialogue keeps your thoughts aligned with your process. Journaling plays an essential role in building that alignment. When you write down not just your trades, but your emotions before and after each one, you start to notice recurring mental patterns. You'll see how impatience creeps in during slow markets, or how overconfidence emerges after consecutive wins. These observations reveal the inconsistencies that sabotage you. Once you recognize them, you can begin to reprogram your responses. You can remind yourself that every trade is independent, that probabilities don't bend to emotion, and that the only thing you truly control is your execution. Another crucial part of mindset consistency is detachment from the outcome of individual trades. Most traders make the mistake of seeing each result as a reflection of their skill, but even perfect setups can lose, and bad trades can win by luck. The consistent trader accepts this and doesn't let either scenario influence the next decision. They don't increase size after a win to chase euphoria, and they don't skip setups after a loss to avoid pain. Each trade is approached with the same mental energy, the same risk tolerance, the same faith in the plan. That emotional neutrality keeps the performance curve smooth. Consistency in mindset also means maintaining balance outside the charts. If your personal life is chaotic, your trading will reflect that chaos. Sleep, diet, physical health, and emotional stability all influence decision-making. The mind doesn't operate in isolation. A trader who is anxious, angry, or distracted cannot expect clear execution. Consistency requires a lifestyle that supports it, a routine that calms the mind before trading, habits that build discipline, and boundaries that prevent burnout. The calmness you carry into the market is built long before the opening bell. The consistent trader develops rituals that anchor their focus. They review their plan before every session, visualize possible scenarios, and mentally rehearse how they will respond to volatility. These rituals create psychological stability. They remind the brain that trading is a process, not a performance. When things go wrong, these routines act as anchors, bringing the mind back to balance. Over time, this repetition strengthens neural pathways associated with calm decision-making, turning consistency into habit. It's also vital to accept that mindset consistency doesn't mean perfection. Even the most disciplined traders experience doubt or frustration. The difference is they don't let those emotions dictate behavior. They've trained their minds to act independently of temporary feelings. Consistency doesn't mean never feeling fear. It means recognizing fear without obeying it. You might still experience hesitation or excitement, but they no longer control your execution. That separation between feeling and action is what defines professional level consistency. When you truly internalize consistency, trading stops being about proving anything. You no longer trade to win back losses, to feel smart, or to validate your system. You trade because it's what your plan requires. Each trade is simply the next step in an infinite sequence. You understand that your job is not to predict, but to execute, not to control, but to respond. You become immune to randomness because your mindset remains constant no matter what happens externally. The ultimate truth is that markets are mirrors of psychology. Inconsistency in results is never caused by the market. It's always a symptom of inconsistency in thought. The trader who can maintain emotional equilibrium through uncertainty will eventually see that equilibrium reflected in performance. The longer you stay mentally balanced, the more your actions align with logic and the more predictable your results become. That is how consistency in mindset transforms chaos into structure, randomness into rhythm, and doubt into quiet confidence. Losses are feedback, not failure, because in trading, every losing trade is a message from the market revealing something about your behavior, your beliefs, or your understanding of risk. The problem is that most traders interpret losses emotionally instead of logically. They see a red number and instantly associate it with personal inadequacy, as if the loss were proof that they're not good enough or that their strategy doesn't work. But losses are inevitable. They're built into the very structure of probability that defines trading. Every professional trader knows that no edge, no matter how strong, wins 100% of the time. The outcome of any single trade is irrelevant. What matters is how you interpret that outcome and what you learn from it. When you see a loss as feedback, you shift from a mindset of reaction to one of growth. The losing trade stops being a punishment and becomes information. Maybe the loss happened because the market conditions changed. Maybe you broke a rule. Maybe you managed the trade correctly, and it simply didn't work out because probability didn't favor you this time. Each reason teaches something valuable, but you can only see it if you detach emotionally. The moment you personalize a loss, you lose the opportunity to learn from it. The pain of being wrong overshadows the lesson hidden inside. Trading, at its core, is a continuous process of refinement. Every trade, especially the losing ones, gives data about what works and what doesn't, about your execution, your emotional control, your patience, your ability to follow through. Losses are like the market's way of testing your commitment to discipline. Will you stay consistent when things don't go your way, or will you abandon your plan at the first sign of discomfort? Most traders fail not because they lose money, but because they refuse to accept losses as part of the game. They resist reality instead of reading it. The reason losses hurt so much is that they challenge our identity. Most people grow up being rewarded for being right, getting good grades, making correct decisions, meeting expectations. Trading reverses that conditioning. In the market, being wrong is part of the process, not something to avoid. You can do everything right and still lose. That paradox is difficult for the human mind to accept. The ego interprets loss as failure because it's wired to equate success with validation. Until you break that connection, every loss will feel personal. But when you redefine what success means in trading, seeing it as following your edge consistently rather than winning every trade, you begin to remove the emotional charge attached to losing. Losses are feedback that help you measure how aligned you are with your plan. When you take a trade that meets your criteria and still lose, that's feedback on market variability, not on your skill. When you lose because you broke a rule, that's feedback on your discipline. When you hold on to a losing position too long, hoping it turns around, that's feedback on your relationship with risk and your need to feel in control. Each type of loss reflects a different aspect of your trading psychology. The traders who grow are the ones who dissect their losses honestly, without self-judgment, and use that information to make subtle improvements. The idea of losses as feedback transforms your relationship with fear. Most traders fear losing because they associate it with pain, but fear disappears when you understand that each loss carries useful data. You start to view losing as part of the calibration process. Just as an athlete uses mistakes to adjust form, or a musician uses errors to tune performance, a trader uses losses to fine-tune execution. Without them, growth would be impossible. If you avoided every situation where a loss could occur, you'd never take a trade, and without trades, there's no progress. The act of losing, when interpreted correctly, becomes essential to mastery. This shift in mindset also changes how you handle drawdowns. Many traders panic when their account dips, believing they're failing, but drawdowns are natural. They're statistical expressions of variance. The difference between amateurs and professionals is emotional interpretation. The amateur sees a drawdown as disaster. The professional sees it as data. They analyze the pattern of losses, looking for structural or psychological errors. Are they overtrading? Are market conditions different? Are they sticking to their plan? By treating losses as feedback, professionals maintain emotional balance even during difficult periods. They adapt instead of reacting. To truly integrate this perspective, you must train your mind to separate process from outcome. This means evaluating your trades based on execution quality, not profit or loss. If you followed your plan perfectly and still lost money, that's a successful trade because it reflects consistency and discipline. The feedback from that loss might be that your setup performs poorly in current volatility, or that you need to adjust your stop placement, but none of that means you failed. On the other hand, if you made money by breaking your rules, that's a dangerous win. It provides misleading feedback because it reinforces bad behavior. The consistent trader learns to value correct process over short-term gain. Losses also expose hidden beliefs. They reveal whether you genuinely accept uncertainty or secretly crave control. Every time you move a stop loss to avoid taking a hit, every time you double down on a losing position to avoid admitting you're wrong, the market mirrors your inner resistance. Those moments are not about money. They're about ego and the human need for certainty. When you begin to see losses as neutral information rather than personal threats, you dissolve that resistance. You become flexible, adaptable, and open to new insights. It's helpful to think of each loss as part of a larger experiment. You are constantly testing hypotheses about your edge, your risk tolerance, and your emotional thresholds. Scientists don't get angry when an experiment fails. They analyze the data and adjust the method. Traders must adopt the same mindset. Every trade is an experiment with a potential lesson. When you lose, you document the conditions, your mindset, and your decisions. Over time, those records reveal patterns that lead to breakthrough understanding. In this way, losses become an investment in knowledge rather than a drain on capital. Another layer of feedback comes from how you react emotionally after a loss. Do you seek revenge by entering another trade too quickly? Do you withdraw completely out of fear? These reactions are feedback about your emotional maturity and risk beliefs. They show whether you trust your edge or are still driven by the need to avoid pain. By observing your behavior after losses, you gain deep insight into the psychological barriers holding you back. The more aware you become, the more control you gain over those responses. Accepting losses as feedback also prevents destructive cycles. Many traders spiral into overtrading after a losing streak because they're trying to get back what they lost. That mentality turns feedback into fuel for emotional decision-making. When you instead interpret losses as information, you interrupt that cycle. You stop reacting impulsively and start responding intelligently. You take time to analyze, to breathe, to understand. You start making adjustments with intention rather than emotion. This mindset not only protects your capital, but strengthens resilience. The trader who views losses as feedback doesn't crumble after a bad day. They review, learn, and adapt. They build emotional endurance, because they no longer resist what's happening. They work with it. Over time, this resilience compounds. You stop being afraid of taking trades because you no longer fear losing. You know that whatever happens, you'll gain something, either profit or perspective. That quiet confidence is what separates long-term success from short-term survival. The paradox of trading is that the more comfortable you become with losing, the more consistently you begin to win. When losses lose their emotional power, you stop sabotaging your own process. You execute calmly, you follow your plan, and you stay aligned with your probabilities. Each loss becomes a stepping stone, each mistake a teacher, each setback a signpost pointing toward refinement. In that state, trading transforms from a battle against the market into a process of continuous feedback, learning, and evolution. Patience and discipline create long-term edge because the market rewards consistency of behavior, not flashes of brilliance. Trading is not a game of speed or intensity, it's a game of waiting for the right moment and acting with precision when it arrives. Most traders fail not because they lack intelligence or knowledge, but because they cannot sit still. They feel an urge to act constantly, to always be in a trade, to prove they can predict what happens next. But the truth is, the best opportunities in trading are rare, and the ability to wait for them separates those who survive from those who burn out. Patience allows clarity, and discipline enforces structure. Without those two traits, no strategy can work consistently. When you observe the markets long enough, you realize they move in cycles of expansion and contraction, chaos and calm. There are moments when everything aligns, the setup, the timing, the volatility, and those are the trades worth taking. But there are far more moments when nothing is clear, when conditions are uncertain or noisy. The patient trader understands this rhythm and stays calm through the slow periods. They don't force trades to create excitement or chase profit out of boredom. They wait, knowing that their job isn't to be active all the time, it's to be accurate when it matters. The market constantly tempts impatience by moving just enough to make you feel like you're missing something. The undisciplined trader reacts to that temptation. The disciplined one observes it and does nothing. Patience and discipline work together like two sides of the same coin. Patience is the ability to wait. Discipline is the ability to act correctly. When the moment comes, many traders are patient when waiting, but lose discipline when it's time to execute. They hesitate, doubt themselves, or exit too early because emotion interferes. Others are disciplined in preparation but lack patience, jumping into setups that don't meet their criteria. The balance between these two traits creates the long-term edge that professionals depend on. Edge isn't just about having a statistical advantage in your system, it's about having behavioral consistency that ensures that advantage plays out over time. In trading, discipline means structure. It means following a plan that defines your entries, exits, and risk before you even look at a chart. It's having a checklist and executing it without hesitation or improvisation. Discipline means saying no to trades that almost fit your rules, but not entirely. It means risking the same percentage every time, not changing your size because you feel confident. It's boring, repetitive, and mechanical, and that's exactly why it works. The market thrives on uncertainty, but discipline introduces stability into that chaos. Every time you follow your plan, you strengthen the neural pathways associated with control and clarity. Every time you break it, you reinforce impulsiveness and emotion. Patience, on the other hand, is mental strength in disguise. It requires emotional control to stay still when your instincts scream to act. Waiting is uncomfortable because the human mind craves certainty and progress. Inactivity feels like stagnation, but in trading, waiting is often the most productive thing you can do. Patience allows your analysis to mature. It gives your edge time to appear instead of trying to force it into existence. The patient trader understands that missing a trade is better than entering a bad one. They measure success not by how many trades they take, but by how many they avoid. The fewer unnecessary trades you make, the more capital and confidence you preserve for when the real opportunity appears. The illusion of constant opportunity destroys more traders than bad analysis ever will. Social media, market noise, and instant updates create a false sense of urgency, as if every moment missed is a fortune lost. That mindset breeds impulsiveness, the enemy of patience. The truth is, there's no shortage of opportunity. The market will always be there. What disappears quickly is emotional capital, the ability to make clear, rational decisions after a series of rushed mistakes. The disciplined trader protects that capital as carefully as financial capital. They understand that once emotional stability is gone, clarity follows it out the door. Patience also creates psychological distance from outcomes. When you're in a hurry to make money, every tick feels personal. A small pullback feels like an insult. But when you approach the market with patience, you detach from that noise. You see each movement as part of a larger flow, not a threat or validation. That perspective allows you to make cleaner, more confident decisions. You're no longer trying to predict every move. You're waiting for the market to show you the setup that aligns with your edge. Discipline extends beyond the moment of execution. It governs how you manage risk, how you handle drawdowns, and how you respond to temptation. The market constantly offers opportunities to break your rules, move your stop a little lower, take profits a little earlier, chase a candle that looks too perfect. Every one of those temptations tests your discipline. The disciplined trader passes not because they are emotionless, but because they've trained themselves to trust their plan more than their feelings. They've learned that short-term relief from breaking a rule always leads to long-term regret. To cultivate patience and discipline, repetition is essential. You train them the same way. An athlete trains muscles through practice and awareness. Every time you follow your rules despite emotional discomfort, you build mental strength. Every time you wait for the perfect setup instead of forcing one, you reinforce patience. Over time, these habits become automatic. You stop needing willpower because patience and discipline become part of your identity as a trader. You no longer fight impulses, you simply don't feel them as strongly. Routines play a major role in maintaining discipline. Consistent pre-market rituals, journaling, reviewing trades, and setting clear intentions all anchor your mind before the chaos begins. They remind you that trading is a process, not a performance. A disciplined trader treats trading like a business. Structured, deliberate, and rule-based, they measure results over hundreds of trades, not single sessions. They don't seek excitement, they seek execution. The patient trader complements this with a long-term vision. They understand that the edge reveals itself only through time, through thousands of small disciplined actions compounded over months and years. The relationship between patience and discipline is cyclical. Patience keeps you from overtrading. Discipline ensures you act decisively when your signal comes. Without patience, you take random trades. Without discipline, you miss the ones that matter. Together, they create stability in a profession built on unpredictability. That stability is what creates the long-term edge, the ability to produce consistent results in an inconsistent environment. Most traders search endlessly for strategies that remove uncertainty, but the true edge lies in mastering your response to it. Patience gives you the strength to wait through uncertainty. Discipline gives you the structure to act with confidence. When clarity returns, there's an irony in trading that most don't see. The less you trade, the better your results often become. When you stop trying to catch every move, you begin to see the market more clearly. You stop reacting and start observing. Patience allows time for probabilities to align. Discipline ensures that when they do, you're ready to strike. Each decision becomes deliberate instead of desperate. Each trade has meaning instead of being an act of compulsion. That's how professional traders operate. Not by doing more, but by doing less with greater focus. Both patience and discipline require surrendering control. You cannot force the market to give you what you want when you want it. You can only control your preparation and your behavior. The disciplined trader accepts this truth and stops fighting the market's randomness. They align with it, waiting for the few moments when probability tilts slightly in their favor. When that moment comes, they act with precision. No hesitation, no doubt, no greed. That ability to wait calmly and act decisively is what creates the compounding effect that turns skill into mastery, randomness into rhythm, and ordinary traders into professionals. Self-awareness is the ultimate trading advantage because the market is a mirror reflecting your internal state, not just a mechanism for buying and selling. Every decision you make, every reaction to a price movement, every impulse to enter or exit too soon comes from within. Most traders spend years studying charts, indicators, and price action, but they rarely study themselves. They focus on predicting the market when the real challenge is understanding their own behavior under uncertainty. Without self-awareness, you can't see the patterns in your thinking that cause mistakes to repeat. The market will expose them again and again until you finally look inward and recognize that every recurring loss has a psychological root. Self-awareness means observing your thoughts, emotions, and impulses without immediately reacting to them. It's the ability to pause before you act and recognize what is truly driving your decision. Are you entering this trade because your edge has appeared or because you're afraid of missing out? Are you exiting early because the setup invalidated or because the sight of red on your screen makes you uncomfortable? The trader who can answer these questions honestly gains control that no strategy can provide. Technical skills determine what you see in the market, but self-awareness determines how you respond to it. The absence of self-awareness is what makes trading feel chaotic. You start a session calm and focused, then one losing trade triggers frustration, and suddenly every decision after that becomes an emotional reaction. You find yourself chasing trades, moving stops, or doubling your position to make back losses. Each action feels justified in the moment, but when you reflect later, you see the pattern of self-sabotage. Without awareness, you're trapped in those emotional loops, unable to step outside them. Self-awareness breaks that cycle because it creates distance between stimulus and response. You begin to notice emotions as they arise instead of being controlled by them. Self-awareness grows through observation and reflection. Keeping a detailed trading journal isn't just about recording numbers, it's about documenting your mental and emotional state. Write what you felt before, during, and after each trade. Were you confident, anxious, hopeful, or frustrated? Over time, you'll see correlations between your emotional state and your trading performance. Maybe your losses cluster when you're tired or distracted. Maybe your best trades happen when you're calm and detached. These patterns reveal who you are as a trader. They show that the real edge lies not in predicting price movement, but in managing your own mind. Every trader has psychological tendencies: fear of missing out, the need to be right, impatience, greed, avoidance of pain. Self-awareness means identifying which ones dominate your behavior. The fear of missing out might push you into premature entries. The need to be right might prevent you from cutting losses quickly. Greed might make you hold winners too long until they turn against you. When you recognize these tendencies in real time, you gain the power to interrupt them. You stop acting automatically and start choosing consciously. That conscious awareness is what separates professional execution from emotional reaction. Self-awareness also builds humility, an often overlooked element of trading success. The market humbles everyone eventually, but the self-aware trader learns before the lesson becomes costly. They understand that no one can predict the future with certainty. They stop chasing perfection and start focusing on probabilities. This humility protects them from overconfidence. After winning streaks and despair, after losses, they see both outcomes as part of a larger statistical process rather than a personal reflection of their worth. Without self-awareness, traders get caught in emotional extremes, swinging between euphoria and frustration. With it, they remain centered. The deeper your self-awareness, the clearer your perception of the market becomes. When you are not clouded by emotion or bias, you can see patterns objectively. Price action stops being personal. It's just information. The chart doesn't care about your opinion, and you no longer need it to. You observe, you interpret, and you act according to your plan. This detachment doesn't make you robotic, it makes you free. You're no longer trying to control outcomes. You're managing yourself within the flow of uncertainty. That shift from external control to internal awareness is where consistency begins. Many traders resist self-awareness because it requires honesty. It means admitting that your biggest obstacle isn't the market, but you. It forces you to confront uncomfortable truths about impatience, impulsivity, or lack of discipline. But ignoring those truths doesn't make them disappear. It just ensures that the market will expose them again. The moment you take full responsibility for your behavior, you gain real power. You stop blaming volatility, news, or manipulation and start focusing on the only variable you can control, yourself. That responsibility turns frustration into focus. Meditation, journaling, and mindfulness are tools that develop this awareness. They train the mind to observe thoughts without attaching to them. When you meditate, you learn to notice emotions like fear or greed as passing sensations rather than commands to act. The same principle applies to trading. You feel fear when price moves against you, but instead of reacting, you acknowledge it, breathe, and stay aligned with your plan. Over time, that awareness creates a gap between emotion and action. The market still fluctuates, but your reactions no longer do. Self-awareness also reveals the stories you tell yourself about success and failure. Some traders subconsciously believe they don't deserve to win. Others tie their identity to being right, so they can't admit mistakes. These internal narratives shape decisions more than logic does. Becoming aware of them allows you to rewrite them. You can replace limiting beliefs with constructive ones, that losses are part of the process, that patience compounds profit, that self-control is strength. Once your internal dialogue aligns with reality, your trading behavior naturally follows. The most powerful aspect of self-awareness is how it transforms mistakes into teachers. Every error becomes an opportunity for reflection rather than regret. Instead of thinking, I messed up again, you think, what emotion drove that decision and how can I manage it next time? That mindset shift accelerates growth because it removes shame from learning. You stop seeing mistakes as evidence of failure and start viewing them as data points about your own psychology. This perspective keeps you engaged, curious, and adaptive, qualities every trader needs to survive. Self-awareness also stabilizes your emotional energy across different phases of trading. During winning streaks, it keeps you grounded. You recognize the subtle signs of overconfidence, taking larger risks, ignoring rules, feeling invincible, and you adjust before damage occurs. During losing streaks, it prevents despair. You can analyze calmly, identify what's within your control, and avoid revenge trading. Awareness acts like a stabilizer, keeping you balanced through the inevitable ups and downs of market cycles. Over time, as your awareness deepens, you begin to see how everything in trading is interconnected. Your thoughts influence your emotions influence your actions, and your actions influence your results. This chain reaction becomes clear. When you observe yourself honestly, you realize that consistency doesn't start with your system, it starts with your state of mind. A calm-centered trader can execute any decent strategy with far better results than a brilliant strategist lost in emotional chaos. The market rewards those who know themselves. It punishes impulsiveness, arrogance, and denial. The more you understand your psychological patterns, the easier it becomes to adapt your system to fit your personality. You stop trying to trade like someone else and start trading in alignment with your natural temperament. Some traders thrive on quick scalps. Others perform better with slow swing trades. Self-awareness reveals which style matches your emotional rhythm. Once you find that alignment, trading becomes less of a struggle and more of a natural expression of who you are. Ultimately, self-awareness turns trading into a process of self-discovery. Every chart, every trade, every outcome becomes feedback about your mind. The market teaches you patience, humility, focus, and resilience, not through success, but through reflection on how you respond to both success and failure. When you know your triggers, fears, and patterns, nothing in the market surprises you anymore. You move from reacting to observing, from chasing to responding, from forcing outcomes to allowing them. And in that awareness, you discover that mastery in trading was never about the market at all. It was about mastering yourself.